Welcome back, ladies and gentlemen. For the next 45 minutes, 50 minutes, we have our liquidity panel. We'd appreciate if you do ask questions throughout the panel to keep some interactivity. This isn't a one-way conversation. This is a communication between yourselves and our liquidity experts up on stage. To push the conversations along, make sure they're lively, and to make sure that you are interacting to get the most benefit out of these conversations, Mitch will be taking the helm as the moderator, and I turn it over to Mitch now.
This is the liquidity panel. Thank you, everybody, for attending. We'll hopefully give you guys a chance to learn some more about liquidity, especially as it relates to the Asian market. So in the beginning, I'd like to let each of the panelists take 1 minute to introduce themselves and say a little bit about them. Rob?
Hi, my name is Rob Fleshler. I work at Hotspot FX, and I'm Managing Director responsible for wholesale liquidity. We've created a pool specifically for a lot of the people in attendance here. My background is originally on the banking side for a dozen years as both sales and as an options trader, and over the last decade in e-commerce. Since the year 2002 or so, 2000, getting into the e-commerce space and watching that evolve.
Hi there, everybody. My name is Stephen Lynch. I work for Nomura Securities. I'm regional head for electronic markets that covers the FX and also the prime brokerage business as well. And our services vary. We're very focused on the retail space. We're having quite a significant push into that area, and we're also very, very focused on the Asia-Pacific region, obviously being a Japanese investment bank.
Hi everyone, my name is Darren. I am the COO of Market Factory. Market Factory is a software engineering company focused on aggregation solutions and co-location for the institutional FX market. We are based in New York and have been in market for around 5 years. Providing such solutions that powers a lot of the bank e-commerce systems and provides prices for ultimately a lot of the platforms that you see. But I'm actually very pleased today to be representing Saxo Bank, and specifically the Saxo Prime offering, which very simply is one point of contact that allows you to receive credit intermediation through a prime of prime vehicle, as well as technology access to all liquidity providers, and finally the technology to make it all happen.
My name is Harpal Sandhu. I'm the CEO of Integral. We're out in Silicon Valley in California. I was going to say that I was one of 2 non-market participants on the panel, but since, Darren, you're representing Saxo, I guess I could say we're the only non-market participant on the panel, in that we are a technology service provider where we provide services to brokers for brokers to run their own businesses. We provide the point-to-point connectivity from a broker to all points of counterparty bilateral trading that they would do in the market, and between them and their customers, and all of the infrastructure for people to run their businesses. So we're a neutral service provider to service providers, and we're not a participant in the market.
Hello, everybody. Good afternoon. My name is Alex Knight. I work for Citi. I look after FX prime brokerage for Citi for Asia, and I also run our margin FX business. One of the products that we have in that business is the trade stream product, the banners for which you will have seen around this room. Thank you.
Hi everyone, my name's Shane Braunstein. I'm the Regional Director of Asia Pacific for Gain Capital. And specifically, we're probably best known, I would say, for our retail or B2C presence, but actually in this capacity I'll be talking primarily as a representative of Gain GTX, which is an FX ECN. It's providing liquidity to actually Forex brokers as well as other market participants.
So the first question, what are some of the challenges in providing liquidity during the Asian session? We'll start with Rob.
I think some of the challenges particular to the Asian session is that usually when New York goes home around 5 o'clock, the market takes a little bit of a break, and then it has a tendency for a lot of expert advisors to trade right around 5 o'clock. And I think people who are participating need to understand that it's not normal to have uniform liquidity 24 hours a day. There is actually a time where, unless you're making prices and trading against your client, most neutral venues and most of the banks that price the neutral venues will take a break at least for 1 minute or 2 minutes, and then as the Tokyo market begins to open, the liquidity that you're used to during New York and London sessions comes back into the marketplace. So I think that's one of the challenges of liquidity.
I totally agree with that. The early morning session in Asia is always a bit difficult. The market gaps quite significantly. You know, what happens is a lot of like the neutral venues, you say, you know, the Coronex and also on the hotspot, there's a point where people just pull out of the market, and the market gaps and it widens for, you know, like I said, a good 2 hours, and then slowly gradually grinds back in again. We have a lot of clients that have obviously expectations that, you know, that time of the market should still be, you know, sub-pip, sub-half pip spreads, which is very difficult to obviously give to clients at 5 a.m. in the morning. So I think the reality is you know, that market gap is a challenge. It's a challenge for everybody to price. Some banks actually put their trading algo business into Australia to more effectively cover that. That's one solution. But it's a global issue. It's not just a regional issue. It's how the market completely operates, and I completely agree with Rob on that point.
Yeah, providing liquidity during Asian hours has always been a challenge. One of the main factors that market participants should really be aware of, and that Saxo has been mindful of, is really having the point of infrastructure in the Asia Pacific region, and specifically in Tokyo TY3, which is where all the bank LPs get their reference price from EBS, which has a matching engine there. So I think that's one key thing. Another is just to have really dynamic pricing where you can control the spread, be aware of rejection rates, be aware of your clientele, and have good customer segmentation in your pricing engine as you provide prices to the clients in Asia. And at times, you know, use the resources that you have to limit price movements.
Darren, just as a follow-up, do you believe that Tokyo is a good place to host systems for the entire Asian market? Or is it basically just good for Japan? Like, does it work for China, Indonesia, Singapore, and the rest?
It's a great question, Mitch, and it's also one that's hard to answer unilaterally in any way. Tokyo is definitely, I think there are really three main considerations when you are considering where to co-locate. And Tokyo is definitely one epicenter, if not the main epicenter in FX. But we can't just always co-locate next to our liquidity providers. We as brokers have other responsibilities to our customers, what infrastructure or location is easiest for them to connect to, and then also where are your technology vendors, and you're probably using more than one, and where do they provide their service out of. So ideally, if you can be in Tokyo, that's great, but Southeast Asia is a growing market. There are a lot of tech providers down there with points of presence providing SaaS solutions down there, so it's a tough balancing act.
So if the question is about, so I'm inferring from the question that liquidity is a problem during Asian hours. Now, I think that's a relevant question if one is a liquidity provider, because you're managing the risk. However, from the broker's point of view, given that the broker now has the option with modern technology to be simultaneously connected to dozens, many dozens of liquidity providers simultaneously, I don't actually feel as though there is a problem with liquidity during Asian hours, particularly for customers of ours, or Asian customers of ours, who are tapping a heterogeneous and wide variety of liquidity from around the world, at least using the Integral network. Case in point being, a couple of days after the Japanese earthquake and tsunami, there was a significant movement in dollar-yen, almost I think it was 5 or 7 pips in a matter of 20 minutes, or the market had moved significantly one way or the other. And it was quite interesting because the FT and the Journal called us really as a source of a vantage point of what was happening amongst the market makers as a group. And our observation was that we had a significant number of market makers who dropped out of the market during that period of time, and liquidity clearly was lighter. However, the aggregate view across 30 or 40 liquidity providers for customers of ours actually was uninterrupted during that period of time. And in fact, our highest growth area, we think, for us is in Asia, because if you have an aggregated view of the market sort of sorts itself out. And granted, there was a period of time at 5 to 5:05 p.m. in New York that people literally reset their systems and do various other things, but Japan really hasn't opened up yet. And by 8 o'clock in the morning Japan time, we actually think liquidity is fine in the market.
Are there any tools you would recommend for brokers when it comes to like price spikes during that 5 o'clock to 5:15 time, New York?
Well, we don't actually see price spikes. I'm talking about a particular instance that took place in and around the time of the tsunami was the price spike. But
I'm referring just on day to day. When the banks drop out, a retail broker doesn't stop making prices.
No. And we don't stop making prices to retail brokers. So we make prices to some of the most significant retail brokers. Actually, I should correct that. Counterparts within our network, in the aggregate, provide prices which we facilitate to some of the largest brokers in Asia, and those are 24/5.5. They never turn off. So even during those 2-minute periods, they never shut off. In fact, if it ever does shut off, it gets posted on the Japanese regulator's site. I mean, the brokers have to put it up on their site. So we haven't had an instance of that in upwards of 12 to 18 months. So we don't actually view that as an issue. I mean, I know it is a common problem, particularly from the liquidity provider side, but it doesn't need to be a common problem at all from the broker side, from the consumer side.
Yeah, I think that's probably a fair point, actually. The demand for liquidity during the Asian session is clearly there. We look in Japan, we see phenomenal demand. We see phenomenal pricing going in there. And of course, I think a lot of the banks are struggling to make money and struggling to show prices as consistently narrow as they would like to in that session. But there is, I think, if people think imaginatively, if they look at a variety of different sources and maybe even a variety of different ways to execute their trades, there is really a fair amount of liquidity available during the Asian time zone. And I think that's demonstrated by the amount of volume that we're seeing during this time zone as well.
I guess I have a slightly different perspective on this one, which is that I think there are occasional challenges. I think interruptions in liquidity, as Harpal indicated, are not necessary for brokers. That should not be a concern to them. But in terms of the depth of market and the ability to execute in the Asia session, I think that the lack of unique, non-dependent liquidity that's in region is still an issue, and that even the banks in this region are looking to New York and London even during Asia session, and that's the underlying source of the issue, and kind of why it's still a question on this panel, in my view. So, slightly different perspective.
Alex, you have something to add?
Sorry, there was just one other thing I wanted to add, which is, as much as the liquidity itself can be an issue, but as I said, I think a lot of the time people who have a broad enough net can cope with that. One of the other issues that we see is the problems arising from brokers using a reference rate which may not be very stable, and seeing orders being triggered in particular off a rate that may not be reliable, and then all of the associated problems that go with that. That in its own right is a problem. Again, it's solvable. It's not beyond the wit of man, but it does require some attention.
Starting with Shane, what are the most noticeable trends you have noticed with respect to liquidity provisioning in Asia in 2012? And if you could provide some specific examples and your opinion on why the trend is taking place, it would be great.
Sure. Well, I think one trend that we all see is a growth in names, right? I think that there's been a recognition in Asia by a diverse group of institutions now that there's value in this market, that there's opportunity. And so we see more and more parties jumping into the fray, if you will, often with the assistance of third-party technology providers like Gain GTX. I guess the example I'd highlight is the Indonesia Commodities and Derivatives Exchange, which launched a few months ago with GTX. And that's one I think that that's a trend I think that's interesting, or indicative of a couple trends perhaps that are interesting. Yes, the growth in names, but also participants not being content to take the beginner steps first, really, and kind of jumping the curve in terms of adoption. So setting up their own customized liquidity venue in that particular case. So that's what I would indicate.
So perhaps in the same vein, client-to-client trading is something that in my prime brokerage role I'm seeing really a great deal of. Consumers or existing prime broker customers who want to provide liquidity to other prime broker customers. Sometimes it's retail aggregators, sometimes it's high-frequency traders. The number of designation notices that we're seeing going across our desk to set up these relationships is staggering. And there are some legitimate reasons for this. One that springs to mind is that it does defray the cost of execution. But equally, I think it's partially a reflection also of the challenges of liquidity in this time zone and the fact that people are conscious of that and they're looking for diversity in their liquidity provisioning.
So we see two things happening in the Asian markets. First off is with the increased sophistication of the customer base, particularly amongst margin brokers, the ability to internalize the flow within their own risk management engines has been challenged. So they've been shifting somewhat from a B-booking model to an A-booking model, shifting their business to some extent to an agency execution model. We've been facilitating a lot of that, and we've seen a significant uptick in numbers of tickets and in straight-through processing that's been taking place amongst Asian brokers. That's one aspect. The second aspect, and I think it's related to your initial question about liquidity, and I think it's what Alex was just referring to. We sometimes misstate where the liquidity really comes from. The liquidity is not necessarily coming from market-making banks who are advertising prices upon which people are initiating transactions. Liquidity comes from the initiator of the transaction. It is the customers themselves who are trading that are creating the liquidity. The question really is who is internalizing that liquidity. Is it being outsourced all the way up to the chain, to the market maker who is internalizing and republishing it back out? Or is technology allowing these actual liquidity suppliers to internalize that flow amongst each other through the use of, in this case, credit intermediation coming from the prime broker? By the way, and I was a little confused, are you speaking on behalf of Citi market making and margin trading, or are you speaking on behalf of Citi prime broking when you talked about the designation notices?
So that was on behalf of prime brokerage.
Right. So one of the things that we do find also that's happening in this market in terms of provisioning is a significant requirement coming from the brokerage community that their counterparts that they're dealing with and their service providers they're dealing with in the market clearly state what their role is to them. And I think this conflict of interest that has been taking place in the market is now finally coming to the fore with a number of the sophisticated participants, that they really want to know that the people they're working with, are they a service provider to them, or are they a counterpart to them? And that fundamental conflict as to whether the person they're dealing with is actually trading on the other side of that transaction or whether they're providing a service to them is now coming to the fore. And a lot of the innovation that is coming out in credit intermediation, where credit parties acting as prime brokers are acting as pure prime brokers and allowing the customer to really make the right decisions as to what they want to do with their liquidity, who they want to trade with, how they want to trade in a more transparent way, is rapidly coming to the Asian market. Something that had come to New York and London a year ago is having a much shorter half-life in terms of the understanding in this market.
We're seeing customers and the market craving more choices in liquidity options. Brokers are under a bit of pressure due to the lack of growth in 2012 compared to the last decade. And consequently, just the increase in regulatory requirements, increase in capital requirements, decrease in vol. This has all affected things. And what we're really seeing is a trend moving away from brokers wanting to run their own B-books to more towards the A-books, STP, agency models. And I think what you're really seeing, and if you look around this room, Mitch, your firm as well, right? The whole prevalence of primes, and that sector really growing. And moving really beyond just credit provisioning to also technology, liquidity, access to bank LPs, non-bank LPs, just anything you can through that in order to get scale.
Yes, certainly. On the credit intermediation side, we've seen an explosion of that. Everybody's pricing everybody these days. It's quite amazing. I think in the last couple of months, we've definitely seen a decline of the B-book in Japan with the weaker yen, with more agency flow coming in directly into the market, that's for sure. I mean, long may it continue. From my perspective, if brokers focus on getting more clients through the door or re-engaging clients that haven't been trading, rather than focusing on the technology and the risk management of a B-book, that's worth way more money to you than the dollar per million you'll make on your B-book. And to be frank, as a liquidity provider, sometimes what your B-books do throw out into the market doesn't always look that nice. It's be a little bit painful. So, you get better partnership, you get better spreads, you get much better liquidity from an agency model, from a bank or for a liquidity provider, than potentially running the B-book. So it's a nice trend. I hope it continues. It also allows us to do more partnerships with our clients because we can be more consistent in our pricing because we know that the client is focusing on marketing their product, their brand, getting clients through the door, educating them how to trade FX, and adding more clients to the participants to this great market.
Steve, would you agree that there's a significant trend in the market of B-books moving towards A-book?
I think it depends. It really depends on where the currency movements are. And I think, like I said, yen being weaker, that's been a major trend down now for the B-book. When we talk to clients, we try to advocate them. It's just to look at just to focus on onboarding clients and looking at the A model. You've got to remember, it's the indirect costs of the B-book. You've got to manage the risk. You've got to have a person looking at it. You've either had to hire a third-party consultant or you're using a vendor software. That's a cost. So you've squeezed another $10 per million out of your business, but your indirect costs and the effort to manage it, that's a lot. That's a lot of effort and time. And from my perspective, it's so much more value add to everybody if it's their focus on trying to get acquisition and grow the market even larger through more participants.
So liquidity providers are smart, and they generally don't make prices that can be used for reasons of if you want to buy 10 million, then if that's the price for 10 million, you're not going to be able to buy 100 million. And then related to retail, if you're really doing 10,000s and 100,000s, then and you're representing that it's retail flow, that's great. But if the guy's a news trader, then that changes the rules again. So liquidity providers, we work very closely with them to try to define what the clients want to do and what their expectations are. And so working with Nomura and Citi and people and other banks and non-bank liquidity providers on our platform, we try to align the demands of the client with trying to educate them on what they need to ask for when they come into the market so they can get the amount of liquidity done that they want to push through or get a tighter price for smaller amounts if it's retail flow. So I would say, working with clients, education, and different choices for different types of business has been an increasing change over the last year or two. And then the other one is that we're a liquidity provider, and so we've tried to connect to a lot of different front ends. So we do have a GUI of our own, which we use to show our prices, because that's the only way you can see them. But we also have a fixed connection. We work with CTrader, we work with FX1, we have a MetaTrader 4, MetaTrader 5. So I think, the amount of front end and product that is going to be increasingly, called for in the future. We've viewed this as one way to work as sales channels, channeling our liquidity through other people's front ends.
Just to carry on a point, I mean, I totally agree with what Bob said. You know, the banks analyse the flow that comes out. Every trade we take, we do look at it, we do analyse it, and we do look for behavioural patterns. You know, we have seen events where models slice and dice, you know, $100 million order, and it comes through in literally clips of 1,000 units, and obviously trying to distribute the trade across a lot of different liquidity channels. And this is where the credit proliferation comes through. So you have a broker who has, let's say, 6 or 7 guys pricing him, all other brokers, and those other brokers have other brokers pricing him, and other banks and other liquidity providers. So that trade gets dispersed, but you see the correlation. So you can see 16 guys all trade, or for 16 different entities, all trade at the same time in the same direction. So you can trace it all back to see who's pricing who. So it's one of those things, we do look at this, and you know, when you see that kind of behaviour, you say to yourself, well, you know, as the end risk manager on the trade, it's very hard to look at that and be able to deal with it, because obviously sometimes you see a lot of spread collapse on that kind of positions. So what we basically do in that sometimes, we be defensive. So we try to encourage all our vendors and all our clients just to be as, you know, as open as you can about the business model. And that allows us to price you better, price you much more accurately. Otherwise, sometimes, you know, banks do have to go into a new broker relationship, you do the KYC, but you're still a bit blind to the flow you're going to get unless you start seeing it. So having an open dialogue with your liquidity providers and your brokers really does help to get the right liquidity for your business.
As a follow-up to that, what are you mentioned you analyze all of the flow that comes in. So what are some of the hedging strategies that you have in your career seen banks use to hedge and to profit from retail flow specifically? And in this market presently, what's a good per million from the bank perspective in terms of retail flow, and how has that evolved over time?
Well, I mean, a bank's hedging strategy is so diverse. I mean, we're not the same size as Citibank, but we have a similar business model where we've got real money, hedge funds, corporates, large rich individuals. So the alpha profile and the correlation of the book is so different. So predominantly what we try to do with a lot of the retail flow is, because you're pricing it at super tight spreads. And when you're pricing into a stack of maybe 10 or 15 banks into one LP, it's very competitive. So you have to be very aggressive, and you have to skew a lot to get the business. So what you're finding, I think most probably in Integral, you'll see that a lot, that, you know, banks are really aggressively, when you get like 10 or 15 banks in a stack, they're crossing the market. It's an inverted price because the skew is so aggressive. So I think what you're finding there is that the banks are actually using that kind of retail flow as a hedge on their book to other institutional flow. So they're using it to get out of position. And that's why you get this such aggressive skewing methodology when you put 15 to 20 banks in a stack, and you're sitting there going, wow, I've got an inverted price by 0.2 pips.
Rob, I know you've spent some time working with banks. Do you have anything to add?
I guess I'd just add that the world's kind of changed. When everybody's making $150 a million, you can make a lot of mistakes and still stay in business. But nowadays, with spread compression, you know, that's the reason. I think everybody would have kept B-booking, you know, for eternity if spreads hadn't come in. So on the one hand, spread compression is great for the client. On the other, it really hurts people who run a B-book. So it doesn't surprise me that we've seen a move to an A-book. So, you know, nowadays, if you're making $15, $18, $20 a million on retail flow, I mean, you're pretty happy. So if you can imagine, if banks are making $20 a million on retail flow, you know, and they've got the skills and the experience and the tools, then, you know, if a broker is B-booking, I mean, realistically, what are the odds of them making a lot more consistently over time without blowing up? So,
Alex, do you have anything to add?
Yeah, I think the only thing I'd add, the thing that makes it sometimes harder is that if you're hedging retail flow or flow that comes from retail brokers, which isn't necessarily retail flow, of course, as we just described. But if you're hedging retail flow alongside a portfolio of other business, which could be hedge fund flow or corporate flow, whatever else, it actually can sometimes work against you. And the guys who are booking flow as retail brokers, sometimes because it's just their own flow, they can almost get better results. And so the banks don't have although they have the benefit of the franchise, it sometimes requires some careful management to actually get the most value out of the flow, rather than it actually offsetting one another in a negative way.
The bank's risk management model is correlation. So, what you try to do is you put thousands and thousands and thousands of different diversified accounts from all across the world into one trading book, and you look for correlation in terms of your hedging and your optimal netting. So that's why the likes of Citibank have such a massive franchise, because they're always looking for more correlation for the book. The greater the correlation, the more opportunity they have to price people more aggressively. And we're exactly the same at Nomura. We look for we look for as many clients as possible. We try to offer the best pricing we can, and we optimize our correlation all the time. Because the more we optimize, the better pricing we can actually disseminate back into the street to build the book bigger.
Harpal, do you have anything to add?
Yeah, I think if you listen to what everyone's saying, they're all talking about the perspective of being a yield manager themselves, right? So they're talking about acting as their own profit center in internalizing flow and what their mechanisms are that they go about in achieving that. But if you step back and look at some of the observations of what's happening in the market that people are referring to about how through credit innovation and new types of intermediation that everybody is connecting with everyone else, what you're actually starting to see is a mechanism where the market is self-hedging all of these transactions. So we actually look at it as an extremely healthy thing that somebody trades into the market and instantaneously and electronically that trade can be distributed in milliseconds across 15 or 20 or 30 different market participants, and everybody's offsetting that trade with everyone else. Because then if you step back and look at that overall market, the market is naturally hedging itself. And it's actually quite a nice stabilizing effect. So you can have situations where you have highly correlated individual sets of flow that are coming in, but the market as a whole can hedge it out as long as people are interconnected. And that is that's the vantage point that we have. So for example, Nomura's flows are a big part of what Integral does. Citi's flows are a gigantic part of what Integral does. And even hotspots. So all of these flows in the aggregate provide the customer with a view of the market that allows them to really face off against the market as opposed to facing off against a counterparty. And that new perspective that market participants now have significantly change how they view how much they can push into the market. Their view of the liquidity, their view of the depth, the view of the certainty of execution, all of that is dramatically shifting. And we actually think it's a fantastic thing. That's why all of this can take place. And then we're seeing that rapidly accelerate.
Shane?
I'd concur with that perspective, candidly. I think the ability of non-traditional counterparties in particular to connect with one another now is, if you look back 5 years, that just didn't exist. And I think that, look back 7 years, that really is a marked change and a shift. And so I think that it's indicative of the health of the market and the kind of broadening of names that you're able to distribute those trades on Integral or GTX or some of these other venues as widely as you can.
Darren?
Yeah, I've learned a lot from all of your comments on this on this topic, and I think to tie it back for the broker in the audience, really, I think there's really a huge opportunity here to invest in the right number of LP relationships, right, in 2013. So the whole right sizing of your portfolio of liquidity providers is a huge opportunity, and to pick the right number is a skillful task for the simple purpose, as Alex was saying and Stephen is saying, there's a tremendous amount of offsetting of diversity of flow that goes on at the bank level between their different types of customers. But the question is, do you have the MIS? Do you have the reporting? Do you have the people who are manning the relationship with these LPs on a day-to-day basis to kind of invest in that activity to help your LPs, help your suppliers, create the best pricing for you and have the best win-win relationship? That's the type of thing that is difficult to scale, and that's where a big partner with the balance sheet and accreditation and can really help out.
And then Darren, I guess, Harpal?
I'm a little confused. Are you suggesting that people should limit the number of counterparties that they trade against?
I think there is...
mathematically,
Sure.
as an engineer,
Sure.
that doesn't make sense. So why would a user, why would somebody who's out here, who can use technology today and connect to everyone in the market, limit themselves in any way?
Harpal, you're a man of the FX market, and you know that this market is driven by the hidden hand of relationship, right? And so because of that, technology has its limitations, and as you also know and have taught me, they're drastically complementary, these two things, when implemented properly.
Rob, do you have any, or Shane?
I'm curious to hear from our friends at the banks, because I think this gets
so
right to
am
the
I.
crux of what you're saying. It's that does a deeper relationship, does a larger or more predictable set of flow actually have benefits for the end user, for the counterparty? Because I think that's at the crux of this, right?
Yeah, I mean, obviously, I've got a slightly different bias, but yes, I think it does. I actually think that from a bank's perspective, when you go into a broker, let's say he's a credit intermediator, so he facilitates a lot of the IBs that are sitting on the bridge. Let's say he takes 16 or 17 banks in the stack. So from my perspective, to be able to even get a chance of winning that competition, you really have to crank down the spreads and really skew tight. So what happens on the bank side is, it doesn't, when you get the trade, there's not that much, because again, think about what the banks do. We're correlation traders. So we match things off. We don't run huge amounts of risk on these books. So what effectively happens is, you get the spread collapse. So from a bank's perspective, I think the optimal number of liquidity providers that a very large, let's say 20 yard or 30 yard a month broker really needs to get excellent fills would be 7 or 8 banks or 7 or 8 liquidity providers, because all the banks would be able to really tighten up. They would be able to not skew so aggressively, which is and treat it in a different manner, and you go back to being a relationship. You've got to remember these guys. When you've got 20 banks all knocking on the broker's door, wanting to have a meeting about their flows, the brokers get up, rightly so, annoyed. It's like, oh God, I've got to go and see this bank again. And so the value of the time that you have with these guys really does diminish. So I would say that I mean, from a personal, selfish perspective, the optimal number is 8. You then can deepen the relationship, you can deepen the dialogue. And, we try to do alternative things. So, we say to clients, look, how can we help you on your bridge technology? Try and diversify the relationship away just to being a liquidity provider, because it's a very one-dimensional conversation. We try to have conversations about technology, and we also talk to them about credit. It's the same dimensional relationship that Citibank franchise has built. It's not just about a price, it's about a credit relationship, it's about a technology relationship. You try to make a 3-dimensional relationship with the client.
Would you say, based on that, roughly speaking, as a guideline for someone building a brokerage, and as they scale, about 1 bank per 3 yards of flow?
I mean, it's like I said, it's...
Wait, can we round it to pi?
No, like I said.
I think that would actually be useful for someone if there is a right sizing amount. There's no real guideline, right? So
there's no real guideline, but I do think it's got to the point when you've got 18 banks in the stack. It's getting a bit ridiculous. It really is.
I just say I agree that it's getting. I agree that it's changing, and I agree that it's difficult for the status quo incumbents. But ridiculous is in the eye of the beholder. because we just talked about the idea that when there are 18 banks, the customer is seeing inverted prices. How is that bad for the customer that they see tighter and tighter prices? How is it? I want to finish one thing. I mean, there was a time in the computer industry when you would buy a PC from IBM, and they would come to your office and install it for you. When the margins got really tight, they stopped doing that. It may be the case that when there are not 18, but there are 80 liquidity providers or 800 liquidity providers, that the prices are so good and the margins are so tight that the liquidity providers can't afford to come knocking on your door to take you out to lunch. But that might be a good thing. That might be the efficient market that all of these users, expect to get with the introduction of technology that can maintain electronic relationships in the hundreds, and not have to, entertain somebody who wants to bundle the credit with the price, the technology with the price. Maybe they just want to say, hey, I can get the credit from a great credit provider, a prime broker. I can get the technology from a great technology provider, Integral. And what I really want from you, Mr. Liquidity Provider, is just the liquidity, just the price. And if I can get them separately, and I can optimize it for myself because it's my business, that's my prerogative. That's what I should do. That's what I should get paid for. That's why my stock price should go up.
Alex?
Yeah, look, I think that is the prerogative. I think where we need to be conscious of limitations, though, is the ability of firms, particularly smaller firms, to maintain a very large number of relationships. The relationships that Harpal just spoke about, the liquidity relationship, the technology relationship, the credit relationship, they all consume time. They all need to be there. They all need to be well run. It needs to be there so that when there's a problem, you know who to turn to and you can get a quick response. And so I think that let's use brokers as an example, every broker needs to consider its own capacity to run relationships and how many relationships can they genuinely sustain, and work off that and look at the incremental benefit of adding new relationships against essentially the opportunity cost of having to maintain those relationships.
I would say that, I think Harpal would agree that brokers should have the ability to customize really their liquidity pools and choose whether it's 800 names or 8 names. They should be able to pick and choose who's in there. But I would say also, I think increasingly, brokers are looking for the Chinese menu or the ability to choose on the credit side as well. To say, we want GTX to help us on the credit side as well as connecting us to the right liquidity provider. So I think one theme maybe that we didn't address as thoroughly earlier, but the proliferation of choice is something that we're seeing throughout the market.
I mean, just going back to the point on the inverted pricing side, we've seen instances where you've got so many liquidity providers in a stack. So you've got other brokers, banks, funds in a guy's liquidity stack. What happens sometimes is that they have a larger order to do. Let's say they've got an order for 10 million. And most, some of the banks and some of the liquidity providers are giving them smaller layers, thinking it's retail. So they give them like a 500,000 or a 1 million layer. You see that 10 million come in, and what happens is it will go all the way through the pricing stack of the liquidity providers. What happens is, because you're quoting very tight spread, that's not a price for 10, that's a price for 500,000. And then what happens is you go through all the liquidity, brokers are actually seeing slippage. So, okay, it's great that sometimes you've got an inverted price, but when you've got a big order and you have to fill it at that level, and you go through a liquidity stack on a VWAP, you get slipped. Because some of the guys in that stack, maybe it's another broker or hedge fund, where it's coming through from another credit intermediation, might reject the trade, and you have to hit the next LP, and the price has moved slightly. So that's my point why I say there's an optimal level of liquidity providers that you want to have in a stack. And you should not be looking just at the spread, you should be looking at your slippage, and you should be looking at your fill rate to optimize the right providers in the stack. You might have guys who, oh wow, he's giving me 0.1 in Eurodollar. Yeah, but if he's rejecting you 55% of the time, what value is he? You want to get, even if it's a slightly wider price, what you want is 100% fill rate, 0 rejects. So that's when I say you should be optimizing your LPs.
Rob?
We've always been known for our non-bank liquidity, and so the way we kind of look at it is that it's important to have bank relationships, and I think what we all want here for our clients is stability of price. But one of the reasons why you get different prices in different venues is you're combining people who make two-way prices and they want you to cross the spread, and you have other people who are showing basically, you know, bid over where everybody else is interested in selling because that's their interest. And so you have two schools of thought. One is I want to take the position, I want to manage the inventory, and the other one is basically here's my two-way price. So to me, yeah, it could be, you know, 5 liquidity providers or 10 liquidity providers or 50 liquidity providers. I think it's just as important to have the right mix. And so you know, maybe it's just 5 banks, and maybe it's, you know, a dozen non-banks, just to give you a little bit of spice, so that you have a combination of 2 schools of thought.
So before we move on to some audience questions, there's something else I'm curious about. I think the audience may be as well. And I'll start with Darren. Basically, what are the benefits and disadvantages of last look from both the liquidity provider side as well as the client side?
For those of you not familiar, last look is a phenomenon in FX where during this matching cycle of a trade where the market maker is aggressed on, the liquidity provider gets a last look and the right, I guess, of last refusal to back out of the trade. And it sounds like last look is becoming a bigger part of the market. You do have some venues out there who claim no last look. A lot of bank liquidity providers may be providing you very high fill ratios and a great service, but I think last look is, or it's proxy, right? So just be aware of other market structure mechanisms that act in the capacity of last look. But this is a function of any market where there's fee compression. And I think, relating back to the previous question, the previous topic of having all these bank LPs, Harpal, you could be right. You know, in a perfectly optimized market, you know, there won't be these hurt feelings and hurt P&L from LPs. But until then, and the LPs do view that they aren't making money on a certain segment of business, right? They will start implementing things like last look, which can be related to higher rejection rates, which is the same as.
And Harpal, how do you feel about last look?
So, first of all, in an OTC market, every market participant always has the choice as to whether they're going to deal with every other market participant. So, if, for example, in the case you're not making enough money off a particular customer, you widen the spread on that customer. Maybe you won't get the business anymore, but that's your prerogative as a liquidity provider. And in our network, given that it's an OTC network, all those issues work themselves out. And I can guarantee you that every market participant in our network that is a service provider, that is a market maker, has to be making money. And if they're not making money, they have the option every single millisecond to pull out, and they would have done it by now. So they each for themselves figure out how they're going to operate and how they're going to make money. Now, having said that, this issue about last look, it's just a microstructure issue. And if you give the market maker the ability to have the last option, the free option to either accept or reject the deal, having that option allows them to give a tighter price to the customer. It's just a mechanism. If you remove that option, they'll have to give a wider price because they won't have the option in the end. And it's just a microstructure issue. And your execution model that you use within your system or that you use provided to you by somebody like us will just take into account how to adjust for the fact that one liquidity may have a last look and another liquidity may not have a last look. One last point about this is that the behavior of last look from the customer's standpoint may not appear that different than the behavior of trading on an ECN where you have missed a price. So, for example, if you see a price in an ECN and try to aggress against it, but you're not the first one to get there, someone else gets there first and the order is taken away, you'll miss the price, and it'll show up as a miss, which is virtually identical behavior that a user might see if they try to aggress on a price from a market maker, and the market maker who was trying to hedge it can't find the liquidity in the back end and then will reject.
Alex, just quickly.
So just quickly, I don't see any really striking trends in this space. It is something that's asked for occasionally. When it's asked for, it's discussed and negotiated, and you know, there's no sort of real issue with it. It will have an impact probably on the pricing, and I think for that reason, I don't see it being asked for all that often by customers.
Rob?
We prioritize firm liquidity over last look liquidity. So, you know, if it's a firm price and it's the same price as last look, then the firm price will take priority in the stack.
And does that also extend between anonymous and disclosed pools?
Yes.
I think there was a proliferation of last looking maybe 2 or 3 years ago, and I think it actually did get a little bit out of control. But the point is, some of the vendors now are getting very sophisticated. Like on the hotspot side, they will not tolerate a liquidity provider giving them a 5% last look. That's effectively a 5% rejection ratio. A lot of the ECNs now, they're policing their liquidity providers. They're not tolerating that kind of behaviour. So, you know, you're slowly seeing the last look trend decreasing over time because you just can't get away with that, and it's something that you know, you have to step up your technology. The banks have to invest more. You have to be faster, and because you have to get that you've got to get that reject ratio down to 0 with some clients, and it's important. And we have venues now, like on Hotspot, where you don't last look, and that's becoming much more of a trend. There's 3 or 4 venue platforms out there that definitely have that.
We're actually going to take a moment just to let the audience ask some questions. Anyone have any questions? Lively audience. Ah, good.
Hi, so Graham from 10. We're a MT4 bridge provider, so we do a lot of connections to Integral, Hotspot. We also do connections to the banks, the cities and Nomura. What's your feeling of anonymous liquidity pools via disclosed liquidity pools? I obviously know that the banks will price some clients directly, but they might also price Hotspot's anonymous pool, and then that goes out to 5 other brokers.
There's 2 types of anonymous pools that are, one I personally find really challenging to price, and another one, it's okay. There's the anonymous pool with something called tagging, where basically the likes of Hotspot and Integral know the client, they would never reveal it to us, but we get a unique identifier code. And then there's the completely 100% anonymous, you're just putting your price in there, everybody can have that. So there's 2 different types. The tagging business for the banks is good business, but it's hard work. You've got to optimize, and optimize. Every single week, there's a dialogue going back to Hotspot on the tags, trying to getting information passed back to us. No names, obviously, because it's an anonymous pool, but we're always trying to improve the pricing on the tag business. The totally anonymous business, it's you know, that's a hard one. I mean, that's a pretty tough environment to price into, personally speaking. So, you know, like I said, we're happy to do anonymous tagging. That's no problem at all. It's just it's more work, but it can be very beneficial. But the completely anonymous pools, they're tough. They are tough.
Alex?
Yeah, my sense on the anonymous side of things is that unless the client really wants that anonymity, I'm not really sure what they're getting out of it, to be honest with you. So I don't know, but maybe a question for Harpal and Rob. You know, do you see that if you're offering both an anonymous and a disclosed stream, where does the client actually get the better execution?
Again, foreign exchange is an extremely heterogeneous market. So many clients have many different requirements, and depending on what they want to do, they should have the choice to do whatever they'd like. We support anonymous pools without tagging, anonymous pools with tagging, transparent bilateral relationships. They can all exist. It's up to the customer as to what they want. But let's just talk very quickly about the implications. One of the reasons for an anonymous pool is you don't have to manage all the relationships. So the simple answer to the question of how can a customer face off against 800 liquidity providers? Do it anonymously. Then they can't show up for lunch because they don't know who you are. So you can still have access to their price, you can still have consolidated credit, and you can have access to 800 liquidity providers. It's available right now.
And you save money on lunch. You save money on lunch.
Well, they were paying for lunch anyway. You might have to pay for your lunches, but at least you get a better spread, a better price.
Integral has to take you to lunch.
Rob,
we'll pay for
how do you
lunch.
feel about this?
I think what we certainly noticed is that having been on both sides of the business, you know, if you have a disclosed business, a bank will make a known customer a tighter price than an anonymous customer. And also, if put in competition with a either disclosed pool or non-disclosed pool, the non-disclosed will have a wider price for the same type of customer than the disclosed. And so, you know, this matrix of how the price gets from its tightest point when two people know exactly who they're trading with one another to its widest point when it's a free-for-all, you know, that's basically how it works.
Anyone else? Shane?
Yeah, I would second actually both of the last two speakers in saying, A, that a lot of end users are looking to customize what Harpal was saying, but also that in our experience at GTX, yes, when you have a known counterparty and there is a relationship, there can be certainly more on offer and often better pricing on offer.
Cheers. Thank you, guys.
Any more questions?
Hi, Cosmo Zhu from FXD. I have a question about the liquidity. What you have seen from the Volcker rule having passed, is there any impact on the liquidity so far, or you have predicted something in the future?
Can you please repeat the
I mean,
question?
the Volcker rules impact on the total liquidity.
Like regulatory rules?
Yes, yes. Volcker rule.
Oh, Volcker rule. How does the the new Dodd-Frank affect liquidity provisioning?
Only Volcker rules.
Volcker rules.
Yeah, it's a good point. I think on the spot market, I don't think there's going to be much adverse impact on the liquidity at all. I think the one thing you might see, it's going to impact things like the NDF market. That's going to have a huge impact. You know, so what you might, one of the things, obviously, NDFs come under the Dodd-Frank ruling. So there's a good possibility, you know, a lot of the NDF business in Asia is actually really driven by the US hedge funds. They're the big guys in that market. And, you know, if they have that kind of ruling on the NDF business, which they have to clear the trades through a CCP, have to put those trades up onto a live CEF, then I think you'll see the liquidity really diminish in that market. They'll pull away from that market, and you'll see they'll never be able to fill or get their orders filled on a screen as they do on the voice, because these guys come in and they're coming in and buying 400 or 500, you know, 1 month Korea in one go. So you wouldn't see that on the screen, and I think the liquidity will dry up in that market. As for G10, I don't really have too much of a view about it, but I can't really see there being so much of an impact on the G10 for spot anyway.
Yeah, I'd second that. I'd say de minimis, but small negative impact on G10 spot. But I think on the NDF side, particularly from Q3, when those SDR regulations come into place, that will have a dramatic impact.
I want to thank everyone, both the panelists as well as the audience, for attending, and thanks.
Thank you, gentlemen.